Here's a situation we see more often than we'd like. An owner sells his company, 28 years of work, good business, good buyer, clean deal. Then his accountant tells him he owes roughly $340,000 more in tax than he was expecting. Didn't do anything wrong. Didn't cut corners. His mistake, you can even call it that, was being profitable and careful. He left earnings inside the company instead of pulling them out. And somewhere along the line, that quietly disqualified him from the largest tax break available to Canadian business owners. He never knew the rule existed. By the time he found out, it was about 3 years too late to do anything about it. I'm Kris Dureau with Green Private Wealth. If you own an incorporated business in Canada and you expect to sell it someday, this is the rule I'd want you to understand before any other. It's called the Lifetime Capital Gains Exemption. When you sell shares in a private Canadian corporation, your gain is normally taxable. And if your business is incorporated, that's what you'd be selling, your shares. You might not think of yourself as a shareholder, but if you own an incorporated business, that's exactly what you are. The exemption lets an eligible individual shelter a portion of that gain from tax completely. Not deferred, not reduced, gone. In 2026, that amount is $1,275,000. Here's what that's worth in real money. In Canada, half of the capital gain is taxable. And Ontario's top marginal rate of about 53.5%, that works out to roughly 27 cents of tax on every dollar of gain. So sheltering the full exemption saves an Ontario owner somewhere in the range of $340,000. One person, one sale, one line on the tax return. And notice I said one person. The exemption is per individual, not per transaction, and not per company. The distinction is worth a great deal of money to some families, and I'll come back to that. But none of it matters if your shares don't qualify. And that's the part most owners have never checked. Let's go back to the owner I described. To use this, you can't just sell the shares in a private company. The shares have to meet a specific definition in the Income Tax Act. There are conditions attached. The one that caught him is the asset test. On the day you sell, at least 90% of the fair market value of your company's assets has to be used in active business carried on primarily in Canada. 90%, that's a high bar. And here's why it's so easy to fail without even noticing. Your company's profitable. Rather than pull out every dollar out personally and pay tax at the top rate, you leave earnings inside the corporation. Most owners do this, and it's often the right call. But that money doesn't sit still. It goes into savings accounts, then a corporate investment portfolio potentially. Maybe it buys a building or a piece of land. None of that is a mistake in isolation. But those are passive assets. They aren't being used in active business. Year after year after year, the active side of your balance sheet grows slowly, and the passive side compounds. And at some point, usually with no warning and no conversation, the passive side crosses the line and your active business assets fall below the 90% of total value. The day that happens, your shares stop qualifying. Nothing changes. You're not getting a letter in the mail telling you about this. The business runs exactly as it did the day before. You carry on for another 3, 5, 10 years, not knowing that exemption you were counting on is gone. That's what happened to him. The business was excellent. The balance sheet had quietly disqualified it. Now, the asset test isn't the only condition. There are two more, and both of them are about time. The first is the holding period. The shares have to be owned by you or someone related to you for at least 24 months before the sale. So if you're considering a change to who owns the shares, bringing in a spouse, adding adult children, moving shares into a trust, that clock starts the day it's done, not the day you sell. And 2 years is the minimum. It's not the recommended window. The second condition is another asset test, and this one is looking backwards. Over the 24 months before a sale, more than 50% of the company's assets has to have been used in active business. Now, why would the Act need two asset tests? Because without the second one, the first one would be easy to gain. You'd let passive assets pile up for a decade, strip them out a week before closing, and pass the 90% test on the day of the sale. Great. That's why the 50% test exists specifically to stop that. It's a 2-year look back, and it means a last-minute cleanup doesn't work. Which brings us to the cleanup itself. If passive assets have pushed your company offside, fixing it is called corporate purification. The idea is straightforward. You move passive assets out of the operating company so active business assets get back to above that 90% threshold. There are a few common routes: paying dividends out to shareholders, moving assets into a separate holding company, loans to shareholders or related entities, and often even a combination. Each route has its own tax and legal consequences. That work is for your accountant and your lawyer planned together, not improvised. What I want you to take from this isn't the technique, it's the timeline. Purification isn't a filing you do at closing. It usually involves a corporate reorganization. And because of the 2-year look back, the benefit only arrives once time has passed. Doing it 2 years before a sale mostly works. Doing it 2 months before a sale does not work. And here's the harder part. Most owners don't discover any of this until a buyer is already at the table and a lawyer starts asking questions in the due diligence. At that point, you have a deal to protect and no room to restructure. So you take the tax hit and move on. Let me ask you 3 questions about your own company. You don't have to answer them for me, just answer them for yourself. 1, how much cash, investments, or real estate is sitting inside your operating company right now that isn't being used in the business? 2, when was the last time anyone calculated your active versus passive asset split? Not estimated it, calculated it. And 3, if you're planning to bring a family into the ownership structure or set up a trust, has that already been done? Or is it still a conversation you've just been meaning to have and haven't gotten to it yet? Those questions are uncomfortable. That's useful information. Most owners we speak with have never been asked them. We put together a free guide called Are You Thinking of Selling Your Business? It covers what buyers look for, how deals get structured, and the planning that needs to happen before you go to the market. It's linked below if you want it. Now, back to the thing I said I'd come back to. Thought I forgot, didn't you? Earlier I mentioned the exemption is per individual, not per transaction. Here's why that matters. If your spouse holds qualifying shares in their own right, they have their own exemption. 2 people. Roughly $2.5 million of gain potentially sheltered instead of 1.25. Go a step further. If shares are held through a family trust, the gain on the sale can potentially be allocated among the beneficiaries of that trust. And each eligible beneficiary can apply their own exemption against a share of it. A family with 3 adult beneficiaries, each using the full amount, is looking at roughly $3.8 million of gain potentially sheltered on a single transaction. In Ontario, that could be close to $1 million of tax. I want to be careful here because this is the part that tends to get oversold. This only works if the structure is real. The trust has to be properly established and administered. The shares have to be held long enough. The qualifying conditions still have to apply. A trust set up the month before a sale does not produce that outcome. A trust set up years earlier as part of an actual plan can. That's the difference between a strategy and a scramble. Which brings me back where we started. The owner described didn't lose the exemption because he made a bad decision. He lost it because nobody was looking at his balance sheet from a tax planning perspective. The disqualification happened years before the sale. He found out afterwards. You can't claim this retroactively, unfortunately. The conditions have to be met on the day you sell and through the 2 years before it. If your shares don't qualify when you sign, there's nothing anyone can do about it after the fact. Not your accountant, not your lawyer, unfortunately not us. So the practical takeaway is this. If selling your business is realistically on the horizon in the next 5 to 10 years, the time to look at this is now. Not when you have an offer, not in due diligence, now. While there's still enough time for the answer to matter. And what that actually looks like isn't complicated. Someone calculates your asset mix, you find out whether you're onside or offside. If you're offside, you have years instead of weeks to do something about it. That's the whole thing. It's a couple hours of work that can be worth several hundred thousands of dollars, and almost nobody does it until it's too late. Now, look, everything I've covered today is general information. It's not advice for just your specific situation. The rules have more detail than I have gotten into here, and the figures change year to year. Before acting on any of it, talk to your accountant and/or talk to us. This is very important to be making sure you have the right team involved with this to make sure you're not missing some of these potential saving strategies. If you'd like a starting point, the guide is linked in the description. It walks through what a buyer looks for, how these deals come together, and what to sort out before you go to the market. And if you'd rather just have the conversation, you can book a complimentary call with our team. Same link. I'm Kris Dureau with Green Private Wealth. Thanks for watching.